Second reason, credit side freeze. In theory, rate cuts should stimulate borrowing, but if businesses and consumers see that the Fed will likely keep cutting rates, why would they borrow now? Why not wait for cheaper loans later? The result, delayed credit demand, add tariffs and policy uncertainty into the mix. And companies just put their investment plans on hold altogether. The Fed wants to boost fund flow, but instead it's causing fund stagnation. Third, reason, policy side failure. Rate cuts can't solve the most fundamental problem of the US economy, uncertainty. Tariff policy swings, immigration policy tightens, AI impacts jobs. None of these can be fixed by interest rates. The Fed can only lower capital costs. It can't give businesses stable expectations. In other words, the prescription is wrong. Fourth reason, trust side collapse. The revision of 910,000 jobs isn't just a technical adjustment. It's a crisis of confidence. Trump said the data is manipulated, the head of the Labor Bureau got fired, and then the numbers really got slashed. What will investors think? So all these years, the data we've been watching was unreliable. This kind of trust collapse is more deadly than any rate hike or cut, because once the data loses credibility, the entire market's valuation chain is shaken. So when you combine these three main threads, it forms a closed loop. Rate cuts weaken, consumption freeze credit, deepen uncertainty, and come with a trust crisis. The result, rate cuts are supposed to be the cure. This time, they've turned into poison. It reminds me of a saying, the Fed's rate cuts are increasingly like a shot of morphine. Short term, it can relieve pain, and stock prices might bounce, but long term, it makes the underlying issue worse. The real problem isn't solved. Instead, it worsens due to delay after the 2008 financial crisis. The Fed cut rates to zero and did QAs like there was no tomorrow. But did US manufacturing recover? Was the debt bubble digested? No. This time, if we get another super easy cycle, it will only make debt larger, asset bubbles emptier, and ordinary people's situations harder. This is the harsh reality. The Fed isn't some market-saving god, it's a fig leaf, the contradictions in the American system. Now that the fig leaf is torn off, the truth is what's truly scary. Folks, since the Fed's master key has stopped working this time, we as investors need to readjust our thinking. The market's logic is undergoing a structural shift. In the past, it was mindlessly betting on liquidity, but from now on, it's going to be carefully choosing the survivors. So what should we do? Let me break down 4 directions for you. First, tier your risk assets. During a rate cutting cycle, it might seem good for all stocks on the surface, but in reality, money will continue crowding into the safest, most liquid plays. The Magnificent Seven might still hold their valuations thanks to inertia. After all, they've got cash flow, tech moats, and policy resources. But what about small and mid-sized companies? Their relief in financing costs is limited, and the market has even less patience with them. If growth slows, their stock prices will get discounted immediately. In other words, a rate cut cycle is a cycle of divergence between large caps and small caps, not a broad rally.